At the moment, the risk is seen to be in gold. Higher interest rates, bad for gold. That will swap into a situation where the risk is seen in the currencies. And if the currency goes to zero, the value of gold in that currency goes to infinity. So I really just don't see the point of saying it's going to be $8,000 or whatever. Get rid of the gold standard, get rid of, if you like, the responsibility for maintaining the value in the currency, and hey presto, we can do what we want. It just shows you the level of intellect amongst our politicians. It's zero. This is the biggest credit bubble in stocks ever. When this one goes pop, there's going to be disaster, absolute disaster. Let's get it over and done with. Let's see the collapse. Let's try and find a new way forward.
Hi, Alasdair. Good to see you again.
Hello, Paul. Nice to be back.
Yeah. Let's talk about gold, of course, but also the rising yields amongst the G7 nations, inflation, the conflict in the Middle East, of course, and all other important macro developments. So let's first talk about gold. End of last month, Deutsche Bank, a big German bank, published an amazing report about gold. It was titled "The Return of History: Gold, Dollar, and the Monetary Future," and it analyzed how emerging markets have been accumulating gold. And it concluded that gold might go to $8,000 per troy ounce should emerging markets, central banks want to have 30 or 40% of their reserves in gold, which would be in line with history and also with the developed market central banks. Also, the report stated that it's worth considering whether the buildup in physical gold in emerging markets might be a precursor to a potential return of gold as an anchor for an alternative future monetary system. I mean, I read the report and it's exactly how I think, how you think, how we've been discussing this for many years. So what do you make of this report, and especially also the timing of such a report?
Well, I have one big question. Why $8,000?
Yeah, they also even had higher targets. So they have a matrix of all sorts of scenarios, but this was sort of the one that was the most interesting to me because it's quite a realistic scenario.
Yeah, I mean, I don't cavil about the argument, but the fact that analysts and it's not just Deutsche Bank, but the major American banks have done something similar in the sense that they're talking about higher gold prices, and they put a they say we expect it to be X by the end of 2027, whatever. I mean, it's quite clear that either they don't actually understand what they're talking about, or alternatively, they do have some understanding what they're talking about, and they're just producing a figure which might be acceptable, if you like, to their readers. Because the reality of the situation is not that being presented. The reality is that we're seeing the end of the fiat currency system.
Hold on, guys. Did you just catch that? Deutsche Bank just dropped a massive prediction, gold hitting $8,000. But check out Alasdair Macleod's reaction. He is not buying these bank models at all. He argues mainstream analysts are completely missing the real threat. This is not just about gold prices going up, it's a warning sign for the total collapse of our paper money system.
When the fiat currency system ends, either the currency becomes a gold substitute, which, is effectively what the Deutsche Bank report is saying, or alternatively, it goes to zero. And if the currency goes to zero, the value of gold in that currency goes to infinity. So I really just don't see the point of saying it's going to be $8,000 or whatever. But, we live in a world of macroeconomic expectations, if you like, where everything works off computer models and spreadsheets and all the rest of it. And, you can just sort of put in your inputs and you adjust the inputs, do this, do that, and you end up with a computed answer, which has actually got absolutely nothing to do with reality. So that would be my criticism of the report. But having said that, I think the origin of reports like this comes from confused analysts wondering why is it that central banks are buying gold? I mean, after all, they think that their currency, whether it's the euro or whether it's dollars or whatever, for them, that's money. That's money. Gold is no longer part of the system. Why is it, therefore, that central banks are buying gold? And so what they do is, they talk to central bankers. I mean, if you're a, senior executive, let's say in Deutsche Bank, of course central bankers. You go and talk to them and say, why is it you're buying this stuff? And the central bankers turn around, who particularly in Asia, who have never been part of this macroeconomic myth, if you like, about the relationship between money and credit. And they say quite simply, well, these currencies are basically, full of risk. We don't want to have that risk. And that's why we get into real money. Oh, says the commercial banker. I suppose I don't really understand what you're saying, but it seems to me that there's going to be more demand for gold by central bankers, sovereign wealth funds, even the man in the street, if you like, in Beijing or in Delhi. We don't really understand why, but it's quite clear that if this persists, then gold is going to go to $8,000, to pick a figure out of thin air. And I think that's the point about these reports. I mean, they're waking up, they're half awake, they're still sleepy. They don't understand what's really happening to their currencies. And I think that's where we are.
Macleod drops a massive fundamental truth. When a government credit currency completely loses confidence and drops to zero, the nominal value of gold inside that fiat paper mathematically stretches to infinity. This is why targeting a fixed dollar price like 8,000 is completely missing the point. Gold is real money. Paper currencies are just temporary government credit.
Yeah, interesting. But you don't think there's a middle road possible where, just like in the past, the central bank holds more gold than they currently do. So the percentage of gold held is going up to maybe like 50, 60, 70% even. But still, the currencies themselves, they float freely and perhaps they orbit around gold as a sun. So no actual substitute, but at least some anchorage with gold.
I don't like middle ways, if you like, some sort of path between, the reality, the hard rock of reality, and the sponge, if you like, of non-reality. It actually doesn't work. If they try and do something like that, it eventually fails. I mean, this is why Bretton Woods failed, because it wasn't a proper gold standard. All it was a means of securing other currencies to the dollar through gold. And it was at the expense, if you like, of US gold reserves, because nobody really believed that the dollar was a proper gold substitute. What do? They sell their dollars, and they sell their dollars for what? Gold. So, particularly led by France.
Right. Yeah.
I got a lot of criticism about France, but the one thing they did get right was the understanding that the dollar wasn't money. Gold was, and that's why, particularly led by their trying to reduce their dollars. We're going back into the 60s now when the gold pool failed. That was what undid Bretton Woods effectively. Bretton Woods was finally abandoned in August 71. So, these half measures don't really work forever. They only work temporarily. Now, temporarily might be, say, 20, 30 years. But, really not much more than that. That's the problem. So when we get back onto a proper gold standard, we'll probably have a number of failures before we actually get there. But the first failure that we're going to see is currencies going down to zero. Why? Because currencies aren't money, they're credit. And demand for credit is basically, certainly in the currencies, which is what gives the currency its value. And if confidence in that currency diminishes, then people won't buy it, and at the margin, they will sell it. And what do they sell it for? They sell it for real money, which is gold. And you could argue...
This historical lesson is critical. Alasdair explains why the Bretton Woods system shattered back in 1971. It failed because it was not a true gold standard. It was just a mechanism pinning global currencies to the US dollar. France knew back then that the dollar was not absolute money, only gold was. History is repeating itself right now as Eastern nations dump Western debt.
Yeah, it's interesting to see that France was in the 60s was such a big proponent of gold, and nowadays it's there's hardly any appetite for gold in France. If you look at retail markets, it's one of the worst markets to be in. Germany, on the other hand, of course, with Weimar still in the back of their minds, are much more interested in gold, and not just the Deutsche Bank, but also the Bundesbank is one of the most outspoken gold fans among central banks in the West, right? They often write about gold in a benign way, just like Deutsche Bank did. So it's interesting.
Well, yeah, I mean, less so. If you could tell me that German individuals were buying gold, then I'd believe what you're saying. But basically, they're not. I mean, this is the extraordinary thing, because in the last century, their currency failed twice, after the First World War and also after the Second World War. I mean, of anyone, they should understand this. And what you're saying about France was interesting, because in 1979, I was commissioned by a consortium bank in London to examine the possibility of setting up an investment business, which would be fed by all, the European members of the consortium. And I never forget going to France and talking to the investment managers in one of the major banks there, which was one of the shareholders in this one. And they said, the trouble is we can't persuade people to get, to sell gold. Now, that was in 1979, for goodness sake, in France. Now, of course, it sort of seems to be very, very different. And I think one of the extraordinary things about the euro is that it's almost divorced people within the European Union, within Europe, from understanding the relationship between gold and credit, gold and currencies. Currencies are credit because currencies are merely an obligation by the issuer, in the case of Europe, the ECB, to deliver its obligation, which is the value in the currency which it issues. And
to dematerialize money in the minds of people, of course, gives a much more room for politicians to fulfill their dreams and ambitions and spend money as they like, right? So it's. But do you think that's all planned from? Yeah.
That's the idea. That's it. I mean, get rid of the gold standard. Get rid of, if you like, the responsibility for maintaining the value in the currency. And hey, presto, we can do what we want. And that's basically it. Yes.
Yeah. And let's talk a bit about the price, because for years gold was negatively correlated with real interest rates. So the higher those rates, the lower the gold price. And this correlation didn't hold in recent years, though, because gold rose relentlessly over the past few years, while rates were also going up. However, since the start of the Iran war, it seems like the old correlation is in play again. Yields across G7 countries are rising to levels that we haven't seen since the financial crisis, but gold is going down. And you also wrote an article about that yesterday on the 20th.